ROI channel, the channel that's obsessed with the art and science of return on investment, coming at you live and direct from Panama City, Panama. Just got in yesterday, so straight to work, guys. A little bit of commentary around the eToro portfolio for Crassus Investments today. Disclaimer, as always, not a financial advisor. None of this is financial advice. Don't be silly. Make sure that you seek out the appropriate professional for you. Everything said here is my opinion, what I'm doing with my money and the money that I manage and look after. So housekeeping out of the way, we're going to talk about the eToro portfolio today and what's been happening. So let's get into it. Hopefully you can hear me okay. I'm just on the traveling MacBook now. So the audio may be a little different to what we're used to. So let's take a look. I want to point something out. Here's the returns over the last 2 years. And if you've been doing what I suggest you do, this is the main account. Okay, so this is the performance. And I have a personal account that copies this account. And what I do is I add to that every month, okay, dollar cost averaging in. The returns, I don't know how to get rid of that. That's very annoying. Sorry, guys. But the returns year to date were up 7.12%. Early days means absolutely nothing in the short term. Over 2 years, eToro has recorded the performance of the fund as 9.96 for this portfolio. If you've been doing dollar cost averaging, my performance is about negative 3.36, okay, which is a lot better than the S&P 500. However, what it doesn't take into account is a dividend yield. So we've been receiving dividends in the meantime, and unfortunately, for whatever reason, that is not calculated into the performance. So we've yielded 4.3% in terms of dividend yield. And I think that's going to be a real key driver of performance moving forwards, with a lot of the companies in which we've invested having committed to giving a large percentage of their free cash flow back, either by buybacks or particularly dividends in the case of energy stocks, of which we own quite a lot. So if you adjust for that, really the performance has been negative 5.66, which is still not ideal. I'd like to have done a lot better than that, but we've outperformed the S&P, where the S&P over the last year was down negative 19.44%. So a few mistakes made in 2022 where I was caught up in paying higher multiples because I fell into the trap of wanting to diversify, and which was just not a lack of confidence, I guess, in terms of my strategy. Everything that I have seen in terms of macro thesis is playing out to a T. And so end of last year, I simply decided that I'm not going to try and placate or to make as everyone happy. I'm simply going to do my strategy come what may. And if that means doubling down into sort of these more volatile positions and seeing that volatility increases, so be it, because those are the positions that are starting to outperform as I originally thought. So moving forwards, that's the way that we'll be positioning, and I'll be talking about some of the key themes that I'm looking at now. Okay, so yeah, if you've been dollar cost averaging in, you're down around 0.3%. You'll be adding back the dividends, you'll be up 1.3%. And depending on where you are in the world, if you exchange, if you use the Forex, the US dollar has been strengthening. And this is what the master account is based on. So you've actually been somewhere, for me personally, with the Aussie dollar, in my personal account, I'm somewhere around 3 to 4% up based on those factors, okay, which don't get taken into consideration, unfortunately, by eToro. So let's take a look at the S&P. Here's the performance from last year, was down at 19.44%. It's annoying that you can't see that with the bar there, but it's down 19.44% from last year. You can Google it. And so we've far outperformed that. I would like to do a hell of a lot better. If I had stuck to my guns, I would have. In my options Mavericks trades, you'll have seen, if you remember, that we actually did over 25% annualized last year. So we had a massive outperformance against the S&P, which was down basically 20%. And so that's the type of performance that I'm looking to maybe not get quite as much, because we don't have access to options markets in the eToro fund. But over the longer term, if we can get double digits return and double digit alpha, to which we're on track, I think that I'd be very happy with that. And I know that you guys, the copiers, would be as well. And it's simply a matter of me being confident and sticking to my thesis, regardless of short-term fluctuations. Yeah, so there we go. Moving forward for 2023, key themes that I'm focusing on: US dollar relative strength index. I think we're going to see the dollar roll over a little bit, with the Fed being forced to slow the pace of their rate hikes. That'll be measured best probably by the Dixie, and I'll show some charts in a second. CPI is the hot topic. That'll determine how much the Fed has an excuse to continue rate hikes or to subsequently pull back. Commodities, of course, particularly oil, we've spoken about that a lot on this channel, and the relative value to the broad index as measured by the price to earnings. So how much are you paying per dollar of earnings to buy the broad index? Okay, so let's talk about the US dollar currency index measured by the Dixie, the DXY. Now, what this is the US dollar versus other fiat currencies around the world. So this red line you see going through is a 200-day moving average, okay? And I've spoken about this before. When we start to see that break down below the 200-day moving average, the US dollar appears to be rolling over. Now, this is generally a great time to enter into emerging markets. Why? Because all of a sudden the earnings are getting a re-rate relative to the US dollar. So more capital from the US, instead of flowing into the US, will start to flow into some of these emerging markets. We're very well positioned there, particularly with Brazilian stocks, as well as Ecopetrol, the main vertically integrated Colombian energy producer. So this is a good sign for us. We've dropped below the 200-day moving average, you can see on the yearly. And if I move into the CPI, move my head out of the way there, here's what we're looking at in terms of where these different components that go into the CPI are tracking. And as you can see, so fuel oil is the big one out here, 40% year on year. It'll be difficult to beat that again in a consecutive year on a relative basis due to the base effects. But what we've got to understand is where all these input costs that go into producing the crude oil, which then goes into refineries to make fuel oil, those are increasing. And so every barrel of crude, in my opinion, is going to have a higher floor underneath it in terms of its cost of production, which means that the refining margins are going to get squeezed. And there are really only two ways in which that can relieve itself. One is for crude oil to drop. But as I just mentioned, for those factors and factors that on the podcast and myself, we've talked about this ad nauseum, I really think that's highly unlikely to be any more than, say, in the 60s. And again, the other side of that coin is the other option is for refining margins to increase, is for refiners to start to increase their cost of refining, of push through. And so then you'll start to see what they call crack spreads, jet fuel and the like become more and more expensive. And with China opening up, that demand, I believe, will support this thesis quite a lot. If we move into the next part of it, here we have the 200-day moving average, 5 years under the DXY. And so we're at 100 now. I expect if that starts to drop down below sort of 97, which is still reasonably high compared to where we have been in the past, I think that then you'll start to see some of our emerging marketplace really flourish purely from the capital input. Those players are doing very well at the moment because they sell, most of them, except for StoneCo, sell products in US dollars. So Petrobras, Ecopetrol, they're selling oil price in US dollars, and they're actually benefiting in terms of their margins with their local currencies depreciating or staying or expected to depreciate. That hasn't happened, interestingly, so much with the Brazilian real. And that's another sign that as an energy investor, we're really starting to see capital realize the importance of energy moving into this decade. Okay, so here's a commodity index. So we're talking about commodities. This DBC is more heavily weighted towards agricultural products. And so as you can see here over the 1 year, it's dropped below its 200-day moving average. And if we see here over a longer time frame, the 5 year, it's still comfortably above that. So they've had a breakout. They look, if you look at this short-term technicals here following my cursor, that looks like they're in a consolidating period, and that could start to break out once again. I think it's highly likely when you consider energy being such a huge part of agricultural cost inputs. If we look at Bloomberg with a slightly different but similar commodities index, here you can see the 1 year, again, below 200-day moving average. And the big one here, this just looks like a gorgeous chart if you're an oil investor, like crude futures, consolidating down towards the 200-day moving average, over a long time frame, and it looks set to retest. So as you can see, it's bounced and then come back up, which is super interesting. So it looks as if, from a technical at least, I'm not a real technical guru, but I would say there that 72.64 is a very, very interesting floor and support price. And I think that we could easily retest this sort of 100 to maybe even 120 into the coming year. And our energy producers would really, really respond well to that, I expect. If we look over the 1 year, you'll see that we've come off a little bit and we're below that 200-day moving average. If we start to get up above that and break through, then I think it's off to the races in terms of what the algorithms will start to buy. S&P 500, here we're sitting on what I think is a resistance level, and I've made trades accordingly in the options mavericks. You'll see that we have a slightly or a small short position against the S&P. The idea there is more tactical. If the S&P drops off a little bit, you might get some broad selling due to liquidity reasons, and we'll have a little bit of a gain on that. We'll sell that and we'll add to certain entry points at a lower level would be the idea. So it's dropped below 4,000, and that's support resistance, in my opinion, around about 3,953. Be interesting to see what happens on the back of that. I expect us to drop down, could go the other way for a bit and then come back down. I just think with liquidity conditions tightening around the world, but particularly being led by the US, I think there's less and less capital chasing these broad index stocks, the majority of which is made up by companies with very, very low cash flow earnings, if at all. So your Microsofts, your Googles, your Teslas, and so forth. That's something I've spoken about a lot, so I won't belabor the point there. And if we look over the 1 year, I think we could drop down to see this kind of 3,675 easily. And that would still be a fairly high multiple from an earnings yield or PE perspective, which I'll show in a moment. So touching on that, here's a great chart. When we look at the S&P PE ratio, okay, and again, it's just $1 paid for every $1 of earnings in terms of the broad index, okay. The broad index is mainly made up of like 5 stocks, okay. It's really the S&P 5, with the FANGs making up most of that as a market cap weighted index. Here we've come back, and I mentioned this last year. You can go back and look at the video when we were around about this point where I said we're looking at a mean reversion, which we did. We came down from around, I think it was 27, 28 at the time, down to 20 at the moment. So currently, investors, mainly institutional capital, buying these indexes are paying $20.66 for every $1 of earnings, okay? What is that in terms of historical mean? So historical median, 15.99, 14.91. So that's fairly high from a historical perspective. And so we could see a 20, 30% sell-off just to get back to mean. Normally we overshoot, so we don't just go to the mean and stay. It's either way up top or way down below. So it'd be interesting to see. I don't expect us necessarily to go back to 5. That would be interesting. But yeah, I think getting back to 15 is a reasonable target, but who knows? We'll see. All we're interested in is our PE ratio for our index in terms of Crassus investment. How much am I paying per $1 of earnings for the companies that we buy? Whatever happens in the S&P happens in the S&P. And so we are way below that. We've got free cash flow yield over 10%. So I'm paying like $10 for every $1 of earnings, all else being equal. But that's highly skewed. If you look into where our heavily weighted positions are, the free cash flow yields are usually around 30% on entry. Okay, strategy. Guys, I'm not going to be updating things every 5 minutes. I'm not going to be getting caught up in short-term fluctuations in the market, and I'm not going to be worried about concentration, risk, or volatility. I'm going to stick to my strategy. Currently 25% cash. I'm expecting a drop down to that level with tightening liquidity. So far, I've been surprised at the strength of the broad index. I think people are mistaken. They're listening to Jerome Powell saying that they're slowing the pace of the rate hikes, but they're still hiking rates. They're still drawing liquidity out of the system. Unless that changes, I'll be waiting for a big drawback in which to deploy that cash. Then what are we going to buy? Same as always, discount to net asset value or tangible book value. That's worked out so far very, very well in the cases of Transocean and the like. Cases such as Demase shipping, I expect this to also repeat, but we'll see. Ideally as well with high free cash flow yields. So I'm looking to get at least 15% yield, okay, for every dollar, getting 15 cents back in the first year minimum, and sectors with upsides, which I've spoken about quite a bit. Looking to make volatility our friend and not be taken advantage of by the volatility. Some reversion to mean themes that I'll be looking at from a sector perspective. The commodities revaluation, I've spoken about that ad nauseum. Shipping rates, I think we may have bottomed in terms of container rates with China reopening, and I'm really hoping that my shipping stocks will start to reflect that, because they really do appear to be very, very cheap. And then select emerging market reversions, particularly in Brazil, which I will speak about in another video. So there we go, guys. Thanks for watching. Please do like and subscribe if you like the videos. You can hit me up on Twitter at the ROI channel. And if you're looking for a value fund with high free cash flow yield that follows that particular strategy, you may wish to copy the portfolio, link in the description, of course, or you can just add to a watch list and keep a track of how we go. Otherwise, I wish you all the best and take care. I'll come back with another video shortly. Thank you.